Welcome back to the Earth stage. We will be starting a panel moderated by Sophie Prudhomme of the Climate Tech VC newsletter, together with leading venture investors on investing trends in climate and sustainability. Over on the Give First stage, there's a panel on how startups or the larger organizations collaborate on pilots and proof of concepts to get solutions to market, led by Jason Jacobs of My Climate Journey podcast, Community and Investment Fund. Either one will be a great choice. You can't really go wrong right now. So next we're going to hand it over to Sophie. Sophie is the co-founder of Climate Tech VC newsletter, which has become a must-read for anyone working in climate and innovation. She and I also co-founded Climate Raise, a nonprofit and network focused on connecting investors to high-performing climate startups led by women. Sophie, I can't wait to hear what questions you have for our amazing panelists, so over to you. And I think you have to push the top right corner. Yep, there we go.
There we go. Technical difficulties. We're back at the office. It's feeling pretty strange. So nice to see everyone. Thanks for joining us. And thanks for the kind intro, Hannah. I'm eager to jump in and have all of our panelists join us. So is it possible to pull everyone up on stage so we can kick this off and get to know everyone's different investment theses? Love it. As folks are coming up here, thanks for adding everybody. This is quite the crew. We've been identified probably by Cody, so thanks Cody, as, quote, some of the most active investors in climate tech, which is quite the honor to be with all of you. And what's interesting about this crew is we all take a different approach. We have different investment theses, we focus on different areas, we write different size checks, and personally have pretty varied backgrounds, whether that's being deep in what folks dub Clean Tech 1.0 or coming in more from the policy side or from industry. So I think no better way to get this started than maybe if we do keep it to sub 1 minute, please guys, and then tell us a little bit about your investment thesis, meaning where, when you play, share with us what pulled you in the first place to come work on climate. So with no further ado, while Shayla's getting set up here, Danielle, would you mind kicking us off?
Sure. Hi everyone, and Sophie, it's great to be here with you and everyone else on the panel. So I'm here with Closed Loop Partners. Closed Loop Partners is an investment firm. We have multiple different fund structures, all of which invest in the circular economy, which is part of the climate story. We look at reducing waste in supply chains and, where possible, converting waste into higher value resources. So spending a lot of time in plastics, packaging, food and ag, fashion, as well as just supply chain optimization more broadly defined. We have a venture fund, a growth fund, a private equity fund, and an infrastructure fund, recognizing that in order to really create systems change, we need to be able to participate in all different parts of the investment cycle. And one of the unique features about the firm is that we have some corporate partnerships with Fortune 500 companies who are investors in one or multiple of our funds. So bringing them to the table in addition to the infrastructure players, which we think is important for creating that systems change. On the venture side, which is what I manage at the fund, we focus on seed and pre-seed stage deals, so writing checks of about $500K into companies and really supporting their growth through subsequent stages. I got into this actually because I started to really nerd out on financial structures and how we could use financial markets to affect change in society. That got me started actually investing in the climate tech space about 10 years ago. So wasn't around for the very first cycle, but kind of went through round two. I would consider this round three, even though I know we're talking about climate tech 1.0 and looking at this as 2.0 sometimes. But really great to be here and excited for the discussion.
Thank you. Awesome. Shale, you're looking good. Ready to go? Want to kick us off for what does EIP focus on and how did you get into this in the first place?
Sure. Thanks, Sophie. Cool. Well, Energy Impact Partners, the firm where I work and I'm a partner, is about 6 years old now. We have about $1.5 billion under management total across a number of different funds with different mandates. The thing that makes us kind of unique, it's actually not dissimilar from what Danielle is doing in the circular economy world, which is that we partner with a coalition of large incumbents, particularly in the energy space, and try to work with them to define solutions that are going to work within the real ecosystem. So in our LP base, we've got 25 or so utility holding companies, about 100 operating companies amongst them, a bunch of other large strategics who share a common interest in the energy transition, like Shell and like Microsoft and Enterprise Rental Car and a couple of others. And our mandate is to invest broadly in climate tech. We have a particular focus in the energy transition, but we also do a bunch of things that are sort of energy adjacent, where energy is a core component of the decarbonization of some other sector. And because we have a number of different funds with different mandates, ultimately EIP invests basically across the whole ecosystem for a startup, from seed stage all the way through pre-IPO, or we've even now dabbled in SPAC land a little bit. So kind of start to finish in the private markets. And I personally am in year, I think, 15 now of focusing on what we call climate tech these days, and used to call various other things. It's pretty much all I've ever done my whole career, though I've done a bunch of different things within it. But I discovered a sort of driving passion for climate change and understanding the markets that will have to transform in order to mitigate it in college. And that's basically been my whole life since then.
Vaughn, do you want to take it away?
Surely. Thanks, Sophie. Appreciate it. Great to be here with everybody. Vaughn Blake, partner at Blue Bear Capital. Blue Bear focuses on data-driven solutions across energy, infrastructure, and climate. We're investing in our second fund now. We generally come in post-revenue, so we're less concerned about the alphabet game and the stage as long as there's post-revenue and there's still plenty of growth ahead. Then we'll come in and prefer to lead rounds generally, writing $2 to $5 million first checks, and then I think something that does set us apart is we generally save about 2x our first check for follow-on. So we plan to be around and to support in good times and bad. Our focus is on the data-driven side. Is really about scalability and leverage. We see software and data providing the greatest bang for each dollar spent, and the highest scalability within creating both digital operating system for the new energy ecosystem, as well as understanding how we can sort of drive renewables to the scale of previous industrialization that exists in the energy supply chain. Prior to Blue Bear, I've been sort of had a vantage point across the startup ecosystem. So started out as a founder, joined a couple of fintech startups early in their trajectory before they were acquired, jumped over to the venture side, created a venture fund focused on applying frontier technology to industrial enterprise end markets, then was an LP for a bit, and seeing the sort of having that perspective and 360 degrees of how entrepreneurship kind of works, operates, and is capitalized. I really recognize the most impactful place to be over the next generation is going to be on the climate tech side. So really excited to be here and excited to have a great conversation.
Rock on, thanks. And Clay, last but by far not least.
Hey, thanks, Sophie. Good to see you again. I'm Clay, work at Lower Carbon Capital, and name sort of gives it away. We're backing technology to help reduce atmospheric CO2. We think of that work happening sort of across three broad areas. Obviously, climate isn't a particular niche at this point. I think it touches everything in every sector around the world. But the way we sort of break things up is technology to help decarbonize some of the hardest to abate sectors. So, chemicals, ag, building materials, a bunch of stuff that I think is kind of on the tail end of, doesn't necessarily get addressed by just electrifying everything. Second bucket for us is carbon removal. So how do we take CO2 out of the atmosphere and put it back in the ground, or turn it into some useful and hopefully valuable materials or chemical precursors? And then the third bucket is a little bit broadly defined as how do we buy more time for the people and ecosystems that are on the front lines of climate. And that includes a whole range of support that we give to like basic research efforts as well as to some for-profit companies. And I think it sort of speaks to how we got into this work. I joined Chris and Crystal Sacco were my partners in this work after about a decade of working for Barack Obama, and they were coming off of 10 years building lowercase capital. And investing wasn't the goal in the beginning. We knew we wanted to work on climate. We just weren't sure exactly what shape that was going to take. In the beginning, if anything, our bias was toward funding basic research. And, I think we inherited both from our own experiences and from what we'd learned, a bias against the kind of viability of clean tech for venture investments. And that completely changed as soon as we got into the space, kind of by virtue of who Chris is. As soon as he walks into a room, we're getting pitched left and right. And I think we were kind of blown away by the quality of the entrepreneurs and also these just like colliding trends that were taking place, from declining costs for renewable electricity to huge advances winning Nobel Prizes in synthetic biology, breakthroughs in electrochemistry driven by massive scale up of batteries, and a whole host of other things that were just creating a very ripe environment for climate tech. So we've been investing in really early stage, sort of pre-seed to Series A for the last few years, have a portfolio now that's kind of pushing north of 40, and occasionally we're kind of creeping into post Series A rounds too. So anyway, it's a little bit lower carbon.
Amazing. I'm glad we went in that order, because that prompts a question which we get asked a lot, right? There's this question around innovation almost versus deployment as a means for having impact in the climate tech space. And we all invest across a bunch of different asset classes, and therefore probably skewing more to innovation versus deployment of existing technologies. Maybe Clay, we'll start with Clay V. Braun here. Clay V. Vaughn of deployment versus innovation. How do they work together? Why do we need both?
Yeah, I want to push back a little bit on the framing of one versus the other. It's not really a choice. It's got to be an and both. We have a lot of technologies now that, especially in wind and solar, and increasingly in starting to see in storage as well, that are reaching a point where market forces are taking hold, and they're just the cheaper, better, more efficient alternative to the, like digging fossil fuels out of the ground. And we need to focus a lot on deployment, and we need to focus on all the enabling technologies that is going to make that deployment possible. At the same time, you don't have to have a fancy degree in any sort of climate science. You can just look at the numbers. The arithmetic is pretty clear. We're pretty fucked, and so it's hard to see at this point, even if we electrified 100% overnight, how we stave off some of the worst consequences in a relatively short period of time for many billions of people and ecosystems and countless species and the general health of the Earth system. And so from our standpoint, you don't get there with just policy or just deployment of existing technologies. You need a whole raft of new technologies that are going to, one, help us get to zero in a bunch of areas that just having cleaner electrons doesn't accomplish. But we also need a bunch of technology, especially in kind of frontier areas like carbon removal, that are going to help us to actually reverse some of the historical emissions that we've put up. So again, I think it's very much an and both situation.
Democratically put. I'm trying to be provocative here. Vaughn, do you have any bits to add there?
Yeah, I mean, I would agree with Clay 100%. We don't see ourselves in competition, certainly with lower carbon. We hope that our approach, which is sort of driven by deployment, by connecting our LP base both on the institutional and private equity side with technologies that are working upon the assets that they own. That's sort of our hack and our ability to drive returns, which we think in turn sort of gives us more capital to further deploy those technologies and keep the flywheel spinning. But if we didn't have the innovation and and the frontier technology that sort of is the tip of the spear that will eventually be incorporated and deployed at a wider scale, then we would be, stuck in a rut. We wouldn't be moving forward. But it absolutely takes a combination of efforts and a combination of timelines and a combination of sort of capital return requirements to make this effective.
Thanks. Shifting gears a little bit, what sectoral trends, what technologies are you most excited about over the next 12 months or so, right? The pace of change and of policy has been extraordinarily rapid in 2020. What are you looking forward to in 2021? Maybe Danielle, you can kick us off.
Sure. And maybe just a last point on some of that, the infrastructure side of things as well. I think we absolutely need everything. I think there's also so much opportunity for large infrastructure players to start incorporating some of this new technology, even at the early days. I think there's a lot of new, increasingly large infrastructure asset owners are looking at climate-related risks to their larger portfolios. And so it's opening the door, and there's a lot of room for that kind of cross-collaboration in ways that I think historically folks that have been building roads haven't been thinking about innovative technologies or new ways of doing things, but they are now. It kind of leads into, I think, how we're thinking about sectoral change. I'm excited about kind of Biden policy plans and everything. We're not investing against anything in that plan as of today, just because I'm not sure what the timing is going to be and what actually ends up being in that bill. But some of the things that we're really excited about from both supply chain and climate perspectives. Supply chain wise, one of the things that COVID really brought out was this need for resilient infrastructure, resilient manufacturing. So we're seeing actually a lot of activity around onshoring, especially with new kind of artificial intelligence and robotics. There's a lot more that can happen near to where consumption centers are, which just means there's a lot of efficiencies. You can create more local economies, both in terms of the flow of materials and then distribution, and making that supply chain really very efficient, eliminating waste really from those supply chains. The other thing on the material side, I think, Clay, you had mentioned a lot of the kind of biotech that's happening. There's just so much happening in terms of fermentation can do so many different things. There's chemistry that can do so many different things. So we're just keeping an eye out on all new forms of materials. I think in this year and probably for the next 5 to 10 years, we're just going to see a lot of innovation and a lot of existing infrastructure that folks who have large fermentation capacity, for example, are applying it in new ways to new materials. And I think that's super exciting. The other thing, just at a higher level, and I think this is reflected on the call right now, for the last, at least, I would say like 10, 15 years, folks who have talked about climate have talked about GHG emissions. I think the scope of that definition is definitely broadening to again, more resilient ecosystems, thinking about biodiversity differently, thinking about supply chains differently. And I think that's something that we're going to see more and more of. I think not just focusing the conversation on GHG, which is, I think, something that was super important and is important to maintain kind of front of mind, especially when we're talking about deploying more solar, wind, technologies that are going to decarbonize the grid, but also looking beyond that to what happens next. It's not just climate change mitigation, but it's also adaptation and resiliency for what comes next.
Well said. Yeah, that begs the question of what's different this time, right? Which I imagine lots of us have been asked, whether it's fundraising or at events like this. You've written a good amount about this and you've experienced it personally as well. So if someone was to ask you what's different this time of climate clean tech 1.0 versus however you want to define where we're at today, I prefer climate tech. How would you explain what's changed?
It is a common question. I think that there are a bunch of things that are clearly different, right? Like one is just time has passed. And as a result, climate change has become more apparent to more people, more governments, more organizations, more companies. And so there's just, I think, like a lot more urgency around the issue than there was 10, 12 years ago, right? So that alone. Second, the first cycle actually happened. So we have a lot of learning we could take from that first cycle. Now, I don't necessarily think that everybody is taking the right lessons. For example, one of the lessons that kind of Silicon Valley took from the first clean tech cycle was don't invest in big capital intensive technology bets. And I think that was actually a mistaken lesson from that first one. Not to say that there aren't opportunities that are capital light, but if you look at what happened in the first cycle, you really boil it down. A lot of investment, like more than half of the VC dollars that went into Cleantech 1.0 went into two big, what ultimately turned out to be pretty bad bets. It was basically thin film solar and biofuels. And if you add those two up, that was billions of dollars of venture capital that basically evaporated. If you subtract those from the equation, there was a fair amount of success in Cleantech 1.0. I mean, Tesla is your perfect example, but there was a bunch of others as well, and some reasonably good M&A. A lot of that was capital intensive stuff, things like Nextracker, making like solar tracking systems and a bunch of other stuff. So there are lessons, though, that I think we learned from the first cycle, particularly around things like time horizons for new technologies, working with the incumbents, understanding the regulatory structure of the markets, and so on. So second thing that's different is just that we now know what we went through the first time. And I do think it's broader now. Like clean tech was about predominantly energy at the time. I still think there's a ton of opportunity in energy, and in some ways it's now getting glossed over in this next phase, which is good for us because we get a little less competitive sometimes. But nonetheless, right now we're taking a very holistic approach to climate tech as opposed to specifically to energy tech, and that crosses a bunch of other sectors where there's interesting things going on. And I think honestly, like many of the investors who are spending a lot of time in the sector now, maybe not all of them, are going in with open eyes about what the challenges are in this space, and they're real, particularly when you're looking at the deep tech stuff or when you're looking at anything that requires regulatory or policy activity. But if you can recognize that, you have patient capital and there are more capital sources. I mean, that's the final thing I should say is that there is a tsunami of capital flowing into this space right now at every level, from early stage venture and R&D through SPACs in public markets and massive new funds. So companies that have a chance are going to get capitalized. They're going to have a shot at it. So all those things make me a lot more optimistic. I do think we will end up repeating some of the mistakes of the last time, right? It's not entirely different, but overall, I don't think it's right to say like venture capital is the wrong model for clean tech. It's the wrong model for climate tech.
Do folks agree, disagree, want to toss anything in there? I mean, it would also be interesting to chat about what lessons might we be relearning again in this kind of second iteration.
Yeah, I mostly agree, Shale, with what you said, with maybe the exception of that hard tech for venture dollars wasn't a total mistake. I think that one of the things that we see is you have to be ready to capitalize some of these hard tech and deep tech companies with capital on hand, or kind of know who's coming next. I think that was something that definitely I have battle scars from. I'm sure other folks on this call have seen some of those challenges firsthand as well. What I think is different now is that there are, to your point, so many new players that are coming through with, whether it's blended pools of capital, you have corporates, your utility backers, our Fortune 500 companies, right? You have different pools of capital that are coming forward in new ways. You also have better structured venture funds that can be more patient or have longer time horizons for some of these deep tech deals, which is I think really important to recognize, right? The traditional venture fund model, I think, is still probably not actually right for a lot of the hardware that's required for some of this transition. There's also plenty of innovation that is capital light, exactly to your point, that I think is perfectly appropriate for traditional venture models.
What exit opportunities make you all excited that might have had a bit of resurgence in the past 6 months or so? I'm thinking SPACs or particularly active corporates, other ways of going public.
Sorry, I missed the question. There was a little bit of feedback, Sophie. Sorry.
All good. we hear a lot of negative talk around SPACs, right? That maybe it's frothy, companies are going public too early. But there's a flip side to that as well, which is, hey, this is a new opportunity for climate tech businesses to go public and to land, right? And hypothetically in a spot that understands that there's a long road ahead still. So where do you fall on that? Like, I'm trying to be the talkative moderator here. Like, are you pro SPAC? Are you anti SPAC? Let's take it away.
Yeah. I think that any of us who have been investing in the space for a while, or especially if you've been investing just broadly in capital markets for a long time, has seen the evolution of the SPAC, especially through the lens of the market. I think the bottom line with any capital structure, it can be wrongly applied or taken advantage of, right? So in this climate, I think there has certainly been, it's been very attractive to be a SPAC sponsor up until about, 2 or 3 weeks ago, maybe a month ago. And when it's that attractive, you end up with folks that may not be in the best position to hold that position. And likewise, there are companies that may not have been really ready for the public markets. Having the ability to speak to forward guidance can really whip up quite a narrative and whip up quite a frenzy in the market. But it's healthy for things to sort of come back to earth, and for folks to recalibrate, and for scrutiny to sunlight to disinfect the issues that aren't quite as high quality. But at the end of the day, for the right company, I don't think there's probably ever been a better mechanism to get capitalized in a permanent capacity, and to really execute on a vision. And it's all about, are these businesses going to be durable, or are they sort of blowing smoke?
I just I guess one quick thing, which is, so first of all, on SPAC specifically, we're in the midst of the SPAClash now, or maybe we're at the beginning of the SPAClash, and it's inevitable that there are going to be some black marks on some of these companies that have SPAC. There will be many more that I think will be interesting in the public markets for a long time. But people focus a lot on SPACs. The other thing that's been happening that's interesting, and that I think will impact exit opportunities for companies, is that the outperformance of climate tech companies has been universal. We created this little climate tech index in the public markets just to track this, because we were curious, and included a really broad basket of companies, right? Ranging from the kind of old school like Vestas, which makes wind turbines, through a bunch of the SPAC. So broad representation. And as a basket, that asset class in the public markets has outperformed NASDAQ by like 2.5 times over the past year, basically, which is to say the public markets are enamored of climate tech at the moment, in part because there's so much ESG inflows. And that means, one, excitement around climate tech SPACs, and we'll see what plays out there. But two, it means that any other sort of semi-incumbent in this space suddenly has much more valuable capital than they did before. And so I think what we haven't seen yet, but are likely to see coming, is a wave of M&A, this has not been a sector that has seen really great M&A historically. It's been one of the reasons why it's been tough to invest in. But I think that the second order effect of what's happening in the public markets is going to be, some really high dollar acquisitions from some of these incumbents who suddenly find themselves with really rich currency.
This will get sort as standards are hopes of which combines as one endpoint is obviously for liquidity, make it common in this. The extent for investing, though, everyone is driven it's super rich, but only the income of desire, all acting levels of sphere. I think just as we think about making sure that we're holding our in a lot of the transparency and accountability at the end of the day, like, you know, we're not walking away with it. We think are gonna, in 2 or 3 years, or actually kind of to outcomes to reduce.
Thanks. There was a bit of audio challenge there, but can you just mute Clay for a second? Awesome. Sweet. I'm not sure if folks caught much of that, but essentially the debate is going to be SPAC attack, SPAC lash. Where is this a boon overall for climate tech as a way to land safely and generate more value? Or like Shale mentioned, are we going to be seeing more corporate M&A? You know, over the last literally 48 hours, right, we've seen almost another $1 billion flowing in from LPs, BlackRock, Temasek, and then this morning, an interesting new fund from Apple on trying to fund forest sequestration. The money's flowing. I think, you know, we need that influx of capital, but also I anticipate that folks will need to start competing a little bit more for some of these healthy deals. And so I hope that the exit opportunities kind of come along with that and that the corporates pick up speed there and grab value as well. So I know we have been scheduled for wrapping at 9:40, I believe. I'm on Pacific time. So is that the right timing? Is that the right timing that we're supposed to be wrapping up soon? I don't want to keep folks from the next panel here. We can keep going for forever. But unless someone boots me off the stage here, I've got more questions queued up for folks. Look into the tech team to kick us out. But otherwise, while we've still got the stage, how are you all keeping up with the pace of deals? It seems like everything's expedited like 10x, right, recently, which is such a positive with all of the entrepreneurs pouring into the space. But literally, how are you keeping a handle on all of that? And also, how are we making sure that the right voices are being heard, right? So it's often easy for folks who might have previously exited tech businesses to figure out how to navigate the venture capital fundraising ecosystem, but not everyone, and some of those folks that might have the most impactful opportunities know how to navigate VC fundraising. How are you all thinking about that?
I think we're getting comments from our tech team to cut it off soon. But just quickly, I'll say, you know, I think it's a great question, Sophie. There's been a ton of new companies popping up. We've had a record quarter. I've seen, I think, over 280 deals just this quarter, right? 280 companies that are looking for funding. It's tremendous, and I think that it's obviously incumbent on all of us sitting here to review those companies and make sure that we are looking and giving time to folks who maybe aren't coming in through traditional kind of network-driven channels. One of the things that we do for that is we have an online application, so anyone can apply on our website, and we do review all of those companies and get back to everyone who submits an application. I'll cut it off there because I know we're over time.
Super. Glad we squeezed that one in. Sorry for holding everyone up, but I think it's important. And for the entrepreneurs out there, you know how to find all of us. I'm sure we'd love to hear from you. So thanks, amazing panelists, and looking forward to doing some good deals and pushing this conversation forward. Thanks.